Explain how this works, Mike, and why the Fed had to engage in a $75 billion repo operation this morning.
Well, basically, the money markets is sort of the plumbing of the financial system. Companies and financial corporations need cash overnight or for short periods of time to fund suppliers, to fund their operations, things like that. They get cash by pledging collateral, in most cases securities, in most cases Treasury securities, and then somebody gives them cash and they pay it back the next day with interest, and that's the money market system. The rates for borrowing have spiked lately, and there have been a number of reasons for that, including a lot more Treasuries in the market as the government funds its deficit. There was a quarterly tax payment due from corporations yesterday to the IRS, so a lot of cash went out on that. And then the Fed's excess reserves have been dwindling. The Fed has been running them down as they shrink the balance sheet, so there's not enough cash in the system there. And all that came together, and we saw a real spike yesterday that continued into this morning. So the New York Fed stepped in to do its own repo operation. The difference is they can create cash. So they took in securities and they lent out cash to provide more liquidity to the system. And maybe the good news is they did $53.2 billion. They had offered 75. So maybe the cash shortage is a little bit less than they feared.
Yeah, the rumor was around 50 as a shortfall. Mike, I thought we had excessive reserves here. What is going on? What does this tell us about, kind of the level of reserves, the level of liquidity out there, and also the way that the Fed kind of structures the system with the IOER, et cetera? Is that working?
Well, there's no evidence that it's not working, and let me tell you what I mean by that. The Fed has been running down its balance sheet because it feels it didn't need the level of excess reserves that it had. Banks want more excess reserves for regulatory reasons because they're considered high-quality liquid assets, so they're holding more reserves than they need to lend. However, that's not all equal. It's not like every bank has excess reserves. The biggest banks, the JP Morgans and Citis, have a lot of excess reserves, but smaller banks may not have any. And so that's put some of the pressure into the funding markets. The Fed has also been trying to plumb the depths of the excess reserve level. How low can excess reserves go and still meet the demand? Some of the markets are saying they have now found out. And the Fed has always planned, when it got to that level, to add more into the system by selling more, rather buying more securities, more QE, if you want to put it that way. But it's not designed to push down rates. It's designed to hold rates steady. They may have to start that process. And the other thing we're going to be watching tomorrow as the Fed meets, Guy, is that the Fed may create a permanent repo operation so that when there are shortages of liquidity, the banks or other financial institutions can go directly to the Fed and borrow. That's complicated, but it may be something they're ready to do.
And the Fed has talked about the so-called standing repo facility before, so it looks like it could be something that they might consider. Is it for definite that the Fed will do something about this? I mean, there are other options, as you say. They could lower the IOER a few basis points. They could do something, interim term before they ever create the standing rate, or they could just ignore it for now, right, Mike?
Well, they could just ignore it because there were idiosyncratic reasons for the spike yesterday, but that it continued today has got to be a little bit worrisome. Now, what happens when you have a spike in repo is the money that might be lent between banks goes into the repo market because the rates are higher and people want to earn more yield, so that pulls the effective federal funds rate up, and the problem you have there is either less stimulus or, in effect, you get a rate increase. So the Fed may trim the IOER rate to try to push down on the effective Fed funds rate tomorrow, but they don't have a lot of room left to do that. So that brings up the question of, do they do the standing repo facility sooner than they had planned? They had a big briefing on it in June. They talked about it. They've been testing it for a while. They might go ahead, but it does impact the rest of the repo market if the Fed gets into the business. So questions about how ready they are to do this and what kind of impact it will have.